Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of Metropolis Healthcare Limited, hosted by Centrum Broking Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Cinderella Carvalho from Centrum Broking. Thank you and over to you.
Thanks, Margaret. Good evening, everyone. I, Cinderella Carvalho, welcome you all on behalf of Centrum Broking on the Q3FY22 earnings Concall of Metropolis Healthcare Limited. At the outset, I thank the management of Metropolis for giving us this opportunity to host this earnings call. From the management team today, we have with us Ms. Ameera Shah, Promoter and Managing Director, Mr. Vijayendra Singh, Chief Executive Officer, Mr. Rakesh Agarwal, Chief Financial Officer. I now hand over the call to the management team for their opening remarks and further insightful discussion on the quarter. Over to you, Ms. Ameera.
Good evening, everyone, and thank you for joining us for the Q3 FY22 earnings call. I hope you and everyone around you is safe and healthy, and I'm joined today by Vijayendra, Rakesh, and SG, our advisors. The presentation and press release have been issued to the stock exchanges and uploaded on the company's site. I hope everyone's had an opportunity to go through the same. Let me start by giving you our thoughts on the quarter that's just gone by. Point number 1, we embarked FY22 with a network expansion plan with a view to deepen our presence across geographies and increase the B2C ratio of the business. Accordingly, we have added 10 labs in about 470 centers in 9 months. Point 2, we have posted strong 31% growth. We've posted strong 31% growth on YOY basis in our core business, which is non-COVID business, excluding COVID, COVID allied, and the government contract. So this is the B2C, B2B core business that we have. Our B2C revenues have also grown strongly over the last few years. In fact, our 9 months FY22, we have crossed the B2C revenues of FY21 and are on course to report our highest ever B2C revenue in FY22. Even in quarter 3, we have grown by 25% on a year-on-year basis. Point number 3, we have successfully acquired Hitech and expect synergies to start contributing meaningfully over the next few years as we have got from our past acquisitions. Happy to share that during 9 months of FY22, Hitech reported 76 crores of non-COVID revenues, higher than the full year of FY21, and is now on course to deliver its best ever non-COVID year. Point 4, we've continued to focus on improving collection efficiency in our business, and accordingly we're able to bring down our debtors to 31 days, a measure of a higher quality of business that Metropolis has been enjoying over the past few quarters. And point number 5, increasing coverage on our home testing business, which has now covered 103 cities. And the non-COVID home visits revenue is now 22% of our B2C business in Q3 FY22, which was much smaller maybe 4 or 8 quarters ago. All the above points are a result of the sustained focused efforts we have put in building a sustainable, consumer-focused scientific brand. We continue to see a long runway of growth for us in the diagnostics industry, and therefore it's important for us to make the investments to further strengthen our brand, scientific image, test menu, expand our leadership team, and on-ground servicing to increase our consumer connect. These investments have led us to dip slightly in EBITDA margins in Q3, along with the deleverage effects on account of loss of revenue due to large government contract, as we had indicated in our previous Concall. This was not unexpected and as per our guidance. Apart from lower government business in Q3, price capping on COVID tests and unseasonal rains in our large markets impacted the testing volumes. In spite of all these challenges faced, we have reported healthy normalized EBITDA margins of 27.5%, that is EBITDA before CSR ESOP and a one-time acquisition cost. We expect some of the digital and marketing costs that to remain in Q4, but expect growth in margins in Q4 on account of higher quarter-on-quarter volume growth in the government contract and the leverage benefits thereon. Hence, we expect to close FY22 at similar levels of normalized EBITDA margins that we recorded in FY21. Happy to share that we have onboarded a Chief Revenue Officer in the leadership team who shall identify ways to augment revenue from existing business segments as well as identify newer growth opportunities. This is in line with our focus to strengthen our leadership team and the middle management. We will continue to make investments in strengthening our team in a bid to capture market opportunity. Let me now share with you our growth strategy on high-tech. As we have completed the acquisition, our focus now will be on time-bound integration of high-tech within Metropolis to extract synergies on revenue as well as on costs. On the cost front, we expect to save on raw material procurement on the back of increased scale of business. Rationalization in infrastructure, manpower, logistics, and usage of Metropolis IT will lead to optimization in operating expenses. This will eventually improve EBITDA margins of high-tech by 3 to 4 percentage points as the integration continues. On the branding front at this point, we have decided to go with a dual brand strategy in Chennai and a single brand strategy in the rest of Tamil Nadu and Karnataka, on the basis of which brand can pull maximum customers. This will lead us to minimize the cannibalization of business in Chennai and at the same time expand the addressable market size for both Metropolis and high-tech. On the business front, we are planning to launch 100 centers in FY23 for high-tech. Further, our efforts are to increase the wellness contribution of the business, which currently is low for high-tech and has room to expand to the level that Metropolis has of 8%. On the high-tech performance, we're pleased to share that the revenue is 95 crores in nine months of FY22 and surpassed non-COVID revenues of 21. This trajectory gives us the confidence that high-tech will close 22 at the best year possible. Let me quickly touch base upon our thoughts with regards to digital and marketing efforts. We are investing in a new tech stack behind the scenes to ensure that the entire ecosystem which engages with Metropolis is automized. This should result in better control over operations, faster turnaround time, higher consumer engagement, thereby strengthening the brand profile of Metropolis. We are not only working on automation and digitization of consumer connects, but also our suppliers, business partners, including doctors, franchisees, and the third-party patient service network. This will require us to make some upfront investments, which has happened in Q3 and partly in Q4, and we remain confident of the sustained returns over a long period of time. Look at it like this. The efforts in terms of on-ground coverage, brand-building initiatives, and technology spends on back-end we engaged in FY16 to 19 period yielded us benefits in the tough period of 20 and 21. Not only were we able to run operations, but we were able to penetrate faster in terms of home visit services, new tests, in a period which was extremely challenging in terms of pricing, intensity of different variants, higher than normal volumes, and availability of skilled technicians and managerial teams. The investments of Q3 and Q4 are somewhat similar to creating that backbone for the next level of growth that we envisage in the business. To summarize, our near-term objectives will be as follows. Number one, execute a time-bound integration of high-tech into Metropolis to extract maximum revenue and cost synergies. Number two, continue the network expansion as per the plan of 90 labs in 30 months to penetrate and 1,800 centers to penetrate newer geographies as well as strengthen our brand in existing geographies. Invest in digital and marketing initiatives and expand the home visit coverage, which will eventually drive our B2C growth and deepen the leadership and middle management talent to focus more on priority areas. Before concluding my part of the speech, I'm pleased to share that the Board of Directors have declared an interim dividend of Rs 8 per share. That's all from my side. Vijender now will take you through some of the operational parameters.
Thank you, Ameera, and good evening, everyone. Let me talk about the key performance metrics which we track for our progress. The first is revenue share of B2C business. B2C business has been one of the core focus areas of Metropolis, and we have steadily made progress on that front. As also mentioned by Ameera, we posted 25% year-on-year growth in B2C non-COVID business in Q3 FY22. Our revenue share of B2C business in focus cities for non-COVID business stood at 59% in 9 months FY22. Our near-term target is to reach 65% contribution. Our investments in digital marketing and scaling of home visit services are with a view to achieve this target. High-tech being a focused B2C player will also aid Metropolis to increase the B2C business, especially in the focus cities of Chennai and Bangalore. Number 2, specialty test contribution. Metropolis has always adopted the science-first approach in the business, which has led us to become the go-to brand for doctors when it comes to recommending specialized tests to patients. Specialized tests on higher realization enhances profitability and creates a differentiating factor for the company. Our specialized test volume and revenue contribution, however, has fallen in Q3 FY22 year-on-year due to lower volume from the government contract. This, as we indicated, is a one-off event, and as volumes return, will normalize in Q4. Going ahead, we will continue to focus on research and development to introduce newer specialized tests in order to provide value to our customers. On home visit testing business, home visit testing is one of the key growth verticals for Metropolis. FY21 has been an extraordinary year for the home visit business as people opted for home visits considering the safety and convenience for COVID as well as non-COVID. In FY22, the growth continued from home testing as well from the centers as lockdown restrictions were relaxed. Overall revenue from home visit dropped in Q3 FY22 due to COVID pricing capping. However, the home testing for non-COVID business remained firm in 9 months FY22. Home visit revenue for non-COVID stood at rupees 74 crore as against rupees 80 crore in the whole of FY21. At current run rate, we shall post strong growth in home visits revenue for non-COVID in FY22. We believe the growth will come from centers as well as home visits for us, and hence our omni-channel strategy we believe is the right way to move ahead. Our home visit coverage has now been extended to 103 locations in December 2021 as compared to 89 in September 21. On digital initiatives, we have ramped up the digital initiatives at Metropolis to make us future ready and create an all-round digital ecosystem for all our customers, partners as well as doctors. Let me highlight few of the initiatives we have taken. Number 1, we have launched e-commerce capabilities on a web platform that will allow Metropolis the capability to connect with other e-tech players. Number 2, we have built a multi-channel interaction capabilities across websites, applications, WhatsApp and chat for our customers. Number 3, for our partners, we have built a roadmap to scale up the home visit business. Number 4, we are digitizing operational process to improve efficiency and turnaround time. Number 5, we are providing enhanced capabilities to retail customers like appointment booking, sample tracking, etc. As a result of these efforts, about rupees 76 crores of revenue came through leads generated via digital medium, which is about 8% of 9 months FY22 top line. Our target is to reach double-digit revenue contribution through digital leads by end of FY22 and increase it significantly over next 3 years. Let me now come to operational numbers. I am pleased to share that we recorded strong 22% growth in patient volumes to 3.3 million for Q3 FY22, while number of tests increased by 24% year-on-year to 6.3 million in Q3 FY22. However, the revenue per patient for non-COVID business dropped by 5% year-on-year to rupees 911, and revenue per test for non-COVID business dropped by 9% year-on-year to rupees 423. This was primarily on account of consolidation with High-Tech, which has lower revenue per patient and revenue per test as compared to Metropolis, as they cater to the value end of the market. Lower volume from government contract also had a negative impact on this, which is expected to reverse in Q4. Including COVID, revenue per patient has decreased by 13% on year-on-year basis to rupees 898, and revenue per test has decreased by 14% on year-on-year basis to rupees 462. As COVID test prices were much higher last year and were capped downwards during this year. Our revenue profile among focused cities and other cities stood as follows. Focused cities, 5 cities including the city and peripheral area around metropolitan region contributed 64% to the total revenue in Q3 FY22. Seeding cities, 8 cities including the city and peripheral area around the region contributed 18% to the total revenue in Q3 FY22. Rest of the other cities contributed 19% of the revenue in Q3 FY22. With respect to geographic distribution, revenue contribution from West region was 56%, South contributed 25%, North contributed 7%, while rest was contributed from East and international locations. To conclude from my end, our focus going ahead will continue on ramping up the B2C business on the back of investments in digitalization, marketing and expanding the home visit services locations, along with the planned network expansion. On the acquisition front, our efforts will be focused towards the smooth and quick integration of Hitech's operation with Metropolis to drive the synergies. That's all from my side. I will now ask Rakesh to take you through the financials. Thank you.
Yeah, hi. Thank you. Good evening to everyone on the call. Let me give you a snapshot of our financial performance. As mentioned earlier, the Hitech numbers are consolidated with Metropolis with effect from 22nd October, the day the acquisition was completed. Quarter 3 financial year 22 revenue stood at rupees 293.1 crore as compared to rupees 274.7 crore in quarter 3 financial year 21, up by 7% year on year. Hitech contribution stood at rupees 19.6 crore in quarter 3 financial year 22 revenue. Non-COVID business contributed 83% of the revenue, while COVID RT-PCR contributed the rest 17% of the revenue during quarter 3. Non-COVID revenue stood at rupees 244 crore in quarter 3 financial year 22 as compared to rupees 224 crore in quarter 3 financial year 21, up by 9.9% YoY. 9% YoY, sorry. COVID RT-PCR revenue stood at rupees 49 crore in Q3 financial year 22 as compared to rupees 51 crore in quarter 3 financial year 21. As COVID test prices were significantly lower this time as compared to last year, same period, even though COVID volume grew significantly in the same period. EBITDA before CSR, ESOP and one-time acquisition cost stood at rupees 80.5 crore in quarter 3 financial year 22 as compared to rupees 90.2 crore in quarter 3 financial year 21. EBITDA margin for the same stood at 27.5% in quarter 3 financial year 22 as compared to 32.8% in quarter 3 financial year 21. The EBITDA margin drop was led by investment of approximately 17 crore in the following. Number 1, investment in digital initiative which impacted margin by 2.9%. Investment in network expansion which impacted margin by 0.5%. COVID-led pricing drop impacted margin by 1%. And upfront investment in manpower at corporate and front-end considering the growth aspiration of the company impacted margin by 0.9%. Accordingly, reported PAT stood at rupees 41.2 crore in quarter 3 financial year 22 as compared to rupees 58.6 crore in quarter 3 financial year 21. The PAT was also impacted on account of higher financial cost due to Hitech acquisition, which has increased from rupees 1.7 crore in quarter 3 financial year 21 to rupees 5.8 crore in quarter 3 financial year 22. Coming to our working capital ratios, our debtor days has significantly improved from 41 days in March 21 to 31 days in December 21. Overall working capital days has increased by 4 days in March 21 to 13 days in December 21 on early payment to creditors. OFC to EBITDA stood at healthy 77% for 9 months financial year 22. Cash and cash equivalents stood at rupees 231 crore as of December 21. This includes payment of 336 crore for Hitech acquisition. Total debt drawn for the acquisition of Hitech was rupees 300 crore, of which we have already repaid 15 crore. Hence, current debt stood at rupees 285 crore. We expect to pay the external debt for acquisition within 3-year time frame. That's all from my side. We'll now leave the floor open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pooja Bhatia from Morgan Stanley. Please go ahead. Pooja Bhatia from Morgan Stanley, please go ahead with your question. Pooja, we would request you to unmute yourself from your handset and go ahead with your question, please. Due to no response, we'll move to the next question, which is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and good evening, everybody on the call. First question, essentially, Ameera, was if you could help me understand the non-COVID patient volume growth. So I'm looking at a number of 2.42 million, which is basically the patient volume for 3Q FY20. any analysis on a 2-year CAGR basis, excluding high tech and excluding all COVID allied, any like-to-like number, could you help us understand what is the CAGR growth we are looking at on non-COVID, please? That's my first question.
Rakesh, you want to address that?
Yeah, you can go ahead with your second question. I think we'll just quickly come back on that. Can you ask the second question?
Okay, so second essentially is on bookkeeping. Could you help us understand some balance sheet headline number for high tech? Just before this consolidation happened from 22nd October, like net worth, net block, cash, and goodwill recognized in Metropolis. That's my second question.
Yeah, sorry, I was looking at the numbers. So can you just, sorry, my bad. Can you repeat this? So we are, from a volume point of view, what you asked is we are growing around 11% CAGR from 20.
Okay, this is like to like, excluding high tech, excluding COVID allied.
Yes,
right?
everything. This is absolute like to like.
Okay, cool. Thank you so much for this. And on the headline numbers for high tech, net worth, net block, cash, and goodwill recognized, please.
Yeah, so basically, as Q3, we are not, publishing our balance sheet. So this number have been formed up, and we are in the process of closing these numbers with our internal external auditors. So I think this number will get formed up somewhere in this month, and in Q4 results when we publish, we will give you all the stake up of the cost which has been incurred and the items where it is going.
Okay, specifically I was looking for, if you could help me just one number on depreciation amortization. Whatever goodwill has been created in Metropolis books, the number you have charged to the P&L in Q3, is that possible to share?
So basically, there is a small amount which will be charged to the P&L because the goodwill, as per the regulatory requirement, is not subject to any depreciation. So I think that's the information I can give you. But in Q4 you will get a further information about it. But the amount to be charged to depreciation will be a very small amount.
Cool. Thank you so much. And just one last request, not a question, that essentially there was very little time gap to analyze the presentation when it's uploaded to stock exchanges and within this call. If you could just have like an hour of gap between these two things, it will help us better to analyze and check on meaningful questions. Thank you so much. Just a request.
Yeah, that's a valid point. Point taken.
Thank you so much, sir. All the best.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, hi. Thank you for taking my question. My first question is to the revenue of seating fee. On the YOS side or on the sequential side, we can see there is a dip, especially in this seating city revenue. So it is largely to do with the COVID number, or non-COVID volume has also impacted their revenue?
So there's a breakup of multiple things. The most important thing is, number one, is that Q3 is always the weakest quarter in the year. So actually, if you go back and look at the history of the industry, not only Metropolis, usually you will find Q3 as the weakest quarter, even pre-COVID. Volumes drop because as festivals are there, Diwali, Dussehra and other festivals, we always see the less number of patients. So that's number one. Number two, we had actually guided in our previous Concall that we are expecting lumpiness in our government contracts in Q3 and that there will be a sharp decline in volumes in Q3 in government contracts, only because it's a quarter-to-quarter thing, nothing else. And therefore, that has obviously impacted in Q3 in terms of volumes and in revenue. Otherwise, the revenues would have been, significantly more. The third piece is the COVID allied tests, which obviously have, as COVID comes down, the COVID allied test comes down. But overall, if you see on the non-COVID piece, there is still a positive movement.
So, is it specific to the seeding city versus your focus and other city? Because there is a growth disparity between the three different geographies. That's why I am asking, like, this government contract is largely in the seeding cities, or?
No, so the government contracts usually span the whole country, but usually tend to be in smaller markets. So actually, you'll probably find a bigger difference in the other cities. So usually, this becomes large amount in the seeding and the other cities, and therefore you may see some change of contribution in those two geographies.
Okay. Thank you. And next question is related to the revenue per patient. As in the presentation you had mentioned for the Metropolis, excluding high-tech, it's 930 rupees. So in that sense, the revenue per patient for high-tech is much lesser than the Metropolis. And if it is the case, then what's the plan to improve those?
Each business has its own positives and negatives. So I think, yes, number one, the high-tech revenue per patient is lower than Metropolis because high-tech is more of a lab that does more routine testing, and Metropolis, as we know, does a large amount of specialized testing. Now, this creates the opportunity that we are able to go back to high-tech customers and actually now be able to educate them on specialized tests and be able to increase the amount of specialized tests from those customers as well. It also gives us the ability to be able to drive wellness packages more in that market. And both these actions could result in a higher revenue per patient in time, but obviously that will not happen immediately in the next 1 or 2 quarters. But I think over the next few years, we will definitely see, we believe that we should be able to see the revenue per patient moving up.
Correct me if I am wrong. Is it in the range of around 550 to 600 rupees for high-tech?
So high-tech revenue per patient is around approximately 700 in Q3, whereas the revenue per patient for MHL is around 932. So overall, the revenue per patient is coming to 911, including high-tech. So if you look at MHL, we are degrowing by 3% year on year on revenue per patient, basically because of the government contract revenue being subdued in this quarter.
Okay. And the last question is related to the employee expenses, which have increased for the quarter. Is it because of a high-tech?
Basically, the employee cost increase from a percentage point of view. One contribution is because of the revenue going a bit down this quarter. That is one reason. And obviously, as we mentioned in our presentation and also in our speech, that we are investing a bit on the front end and the leadership team. So that, I think, cost is coming upfront. But obviously, we'll see benefit of it coming in the next quarters and time to come.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead. Shyam Srinivasan from Goldman Sachs, your line has been unmuted. Please go ahead with your question.
Yeah, I can. Can you hear me?
Yes, we can hear you now.
Yeah. Good evening. Thank you for taking my question. Just first, I'm looking at slide 25, high-tech strategic initiatives. So I think in the opening remarks, it was mentioned we are doing the dual brand strategy, but slightly different with a single brand in Tamil Nadu and Karnataka. Exception is Chennai. So what's the thought process here? How do we manage this kind of integration? And also, October 22nd to now, how has your experience been when you look at high-tech, how it's been performing relative to your expectations while you're doing your due diligence?
Thanks for the question, Shyam. So let me start by answering the second question first. I mean, it's obviously been about 3 months now. And obviously, we've been busy in not only in closing formalities and also the basics of when you do a acquisition in terms of making sure that your compliances, your billing, all of your bank statements, all of those things are getting completely aligned. So all of that has been done. We have also initiated some of our synergy plans on the cost side, in the first 3 months, and those are well on track. We had already made a very detailed integration plan, pre-acquisition, spanning what we will do in the first 3 months, 6 months, 9 months, etc. And as of now, for the first 3 months, we are on track with our plan. There have not been any surprises at this point of time or anything we have discovered post entry, because I think our diligence and spend time on the understanding of the business was fairly good. So that's on that piece. On the second piece, which is on the question around the strategy and the brand around it. See, the idea is that majority of the business of high-tech is in Chennai. And as we all had already mentioned, Lister Metropolis is the number 1 player in Chennai and high-tech is the number 2 player in Chennai. And the idea is that there is a different positioning that both these brands have in terms of pricing, in terms of the kind of testing they do, and what are the strengths in the mind of the consumer and the doctor. And the idea is not at this point just to put everything together, but the idea is to leverage the strengths of each brand in the market of Chennai. So together, we continue to have the leading market share in Chennai, which is close to now, we believe, about 25 to 30%. So the idea is to expand both, and that's what we will be doing for the next few years. On the back end, however, we are looking at opportunities to say, how do we not duplicate costs and how do we not duplicate capabilities in both brands in Chennai? So while on the back end, we are working at synergizing, on the front end, we are continuing to expand both as independent brands. As far as the rest of Tamil Nadu and Karnataka, in both these markets, we have found, rest of Tamil Nadu especially, we found a good overlapping of cities as well. And we felt that in neither of these markets do we have enough of a volume in either brand to just continue two brands. And it made more sense to actually bring the two together and have one brand strategy that we go ahead with. And we found that the positioning and the pricing was not very different either, and therefore it will be easier to do. So in Karnataka and in ROTM, we are going with a single brand strategy, while in Chennai, for the time being, we are going with a dual brand strategy.
Got it. Very helpful. Just in the 95 crore 9-month high-tech, how much is coming from Chennai?
I don't have an exact number for you,
okay.
But majority of it would be sort of coming from Chennai. I think maybe about 70, 75, 80%.
Yes, absolutely. 70 to 75, between 70 to 75%.
Got it. Last point on this particular thing, margins expected to grow by 3-4% for high-tech. So is there of things that you just said, or is there more on the cost that we can do in terms of synergies, or can you help us explain how we improve margins and what is current margins for high-tech?
So traditionally, high-tech has had sort of pre-acquisition, the margins were close to Metropolis margins, around the same 28% approximately, so similar margin profile. What we often find in these acquisitions of smaller players or regional players, they have obviously not invested as effectively in technology, in quality of team, in processes and systems, and therefore usually when an acquisition is done, the buyer does need to make certain investments in making sure that not only compliances but also processes and systems are invested into to handle scale. On the flip side, there are some cost savings and efficiencies and levers which can be pulled, in a short time frame that also give some cost savings. So we have to look at the net of this when we are talking about sort of margin expansion. And the third part is obviously as we continue to expand and we hire teams and we hire and we build centers and all of that, initially it will be investment rather than immediate revenue. And therefore that will also play out. And which is why we said that we believe that there is a margin expansion. But we don't want to, at this point, push ourselves to try and achieve that margin expansion in the next quarter, because the focus at this point should be more about putting the right processes, systems, and the revenue and growth, rather than just saving cost. And so we believe that we can get to these margin numbers, soon, and that's the goal.
Got it. Thank you, and all the best.
Thank you. The next question is from the line of Pooja Bhatia from Morgan Stanley. Please go ahead.
Greetings, everyone. I'm sorry I got dropped out. I'm not sure if my questions have been asked already. So my first question is on network expansion, and there are 30 labs and 600 centers for this year. Looks like a lot of the deals have in the pipeline have been bunched up to Q4. So is it only due to COVID, or are there any changes in negotiations in the terms?
So actually, we only announced the strategy, Pooja, in July sometime. So really, it's been only 6 months of energy and efforts by the team. And very surprisingly, we've already managed to do about 8-9 centers, in this last 6 months. And I think there are another, if I'm not mistaken, about 10 centers planned for Q4, which are already in progress and getting launched as we speak. So this year we should be able to do about 20 labs. and the estimation of about that 500-600 centers, collection centers. Next year, the idea would be to do about 30 labs and similarly around 600 centers, and then the balance, in the third year period. I think we are very much on track as far as our plan, because obviously we built a new team to execute these. So we never expected that we would do 30 labs in the first year. We always planned that we would do about 20, because we only had 9 months of the year to actually execute them.
Understood. And how are the terms of the agreement generally? Revenue share, profit share?
These are a combination of greenfields and what we call as lab on lease. The greenfields obviously just are our own labs, so we are paying rent and starting labs in these locations. So there's really no revenue share or profit share. In the lab on lease model, these are all long-term agreements where there is a revenue share, on the existing business that they hand over, plus a lesser revenue share on the new business that's generated. But all these are obviously long-term contracts.
That's helpful. On Q4, generally seasonally, it is a better quarter. So this time, it could be different given that there is the Omicron outbreak. So how has the core business done so far in the first, a few days of this Q4, both on the acute and the chronic side, routine and semi-specialized, specialized?
Yeah, I mean, like you rightly said, obviously during the wave, obviously the non-COVID business does get temporarily impacted, and that's obviously what has happened in January. But this time Omicron being obviously a very easily transmissible but not a very severe disease, I don't think it's been as sort of deep a shock as it was in a couple of the waves before. And therefore, I think quarter 4 should still be a fair quarter. I think it's still a bit early to sort of comment on whether it will be very good or not. I think it would be too presumptuous to mention that at this point. I don't know, Rakesh, Rajinder, if you want to add anything to that.
No, so January, obviously, we have seen it's more or less normal, and as January was also impacted by COVID, third wave, so we have seen some fluctuation in the numbers. And obviously it's again too early, as rightly said Amira, that we need to really get more deep into further to understand the whole quarter. So that's how I will put it.
Okay, and last one from my side on the digital front, is the cash burn 40 to 50 million a quarter? Is this number correct? And how does this go going forward?
Rakesh, do you have a specific comment on that?
Yeah, so basically, this is actually not that way cash burn, because we are investing this money into our digital initiatives. So we have invested some 4.5 crore rupees extra in quarter 3, and which are giving us good result as we are getting more leads. And on that basis, we will see more conversion happening in future, and obviously revenue increasing on a not on a paid marketing but on a organic marketing. So I think that is how we are looking for future, that we are investing this now to bring people on board, and then maybe these people will then hook to us and then keep coming to us again and again. So that is how we are looking at it. So from an investment point of view, we have done this 4.5 crore extra investment in marketing, and this will continue to some extent, as also guided by in the earnings call, that we will keep investing some amount every quarter so that we can get more and more leads and more customers into our digital platform.
And I think some of this is, while of course a lot of it is marketing, but some of it is also just in building the platforms, the cost associated with doing digital in general. So whether some of it goes into the cost of technology, some of it is the cost of the people, cost of setting up new processes, etc. And some, of course, a lot of it is in digital marketing.
Operationally, how has the website views been in the last quarter? Any update on that? Is it grown or?
We've put a slide actually in the presentation on the traffic, etc. And we are seeing definitely a growth quarter to quarter. As far as the website traffic as well as the increase in digital users.
So I think you can just see this 9-month update we have already given, that there is 276% increase in digital users, So we've increased our digital users coming to our website is increased by 276%, and there is a 297% increase in the website views in 9 months. So this is the kind of increase we are seeing in the numbers of visitors in the website.
And does this imply double-digit contribution on the revenue front by Q4?
Yeah, so we are seeing a 8.5% of contribution to the top line from digital, which is increasing every quarter. So we are expecting that this should go to the double digit by end of this year, and maybe we will step up the number again much higher in the next year.
That's it from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Just again on the margin front, like considering the initiatives on the digital front, plus considering the aggressive addition of labs as well as addition of the manpower, how do you see the margin profile? And plus at the same time you have the high-tech synergy as well, parallelly going on. So how do you see the margin profile over, let's say, next couple of years?
If you look at pre-COVID, our margin was approximately 27 odd %. And it was during COVID of the year of FY21 and 22, where it of course increased, more significantly, largely because of the additional volumes that were coming in through COVID into the existing infrastructure. There were also the other reason was that we worked on a lot of cost efficiency on the back end, and we also managed to save a lot of costs, which are very sustainable in nature. So overall, I think the actions that we took in 21 and 22 have been very helpful to expand the margin. And we are now using those same savings to actually really reinvest in the business to expand for the next growth. Because at the end of the day in business, there's always going to be a choice to say that, look, should I focus on revenue at this point of time? Should I focus on margins at this point of time? And while we focused on margins the last couple of years, we think it's time now to refocus on revenue without really compromising margins significantly. So, like, what are the things? There is obviously also a lot of competition in the sector, and therefore it's important that we build out the digital piece. It's important that we, continuously keep, advancing our services towards excellence. We make things easier for the consumer, and at the same time expand our footprint all across. So I think, generally, I think that's the direction we are going in, and I think the profit margin of 21 and 22, as we had always said, was a elevated profit margin. But we think going forward, it will be at a more normalized level, as we have seen on a more consistent basis.
Got it. And secondly, on this e-commerce side, while we have our own digital platform, but are we also thinking of providing, as a portfolio or as a package of service on the other websites in terms of as a marketplace per se?
No, absolutely. We are already tied up with players in the health ecosystem, and participating in the digital growth on its own. So that is a part of the journey as well on the digital side. It's not only about what consumers come to us, but it's about how we can partner with others in the health ecosystem, and if they are generating consumers, how we can support them from a pathology and diagnostics perspective.
All right. Thanks. That answers me. Thanks a lot.
Thank you. The next question is from the line of Madan Gopal Ramu from Sundaram Alternates. Please go ahead.
Good evening. If I look at the non-COVID business for the current quarter, and if you remove, you mentioned that digital contributed 10%, so probably it would have come year-on-year basis. The base business seems to have been flat almost. Is there any loss of market share due to the new age companies coming and competing with us? Because at any point we would have expected at least a mid-teen or low-teen sort of a growth in the base business to continue, right?
So I think there are two, three things happening in the industry, right? Firstly, I think digital and offline are all obviously going to feed off each other because finally, usually, anytime you see the industries come together, it's never going to be completely additional. I mean, it's the same patient who is now also exploring digital as a means to, so when we say we are acquiring a consumer through digital, it doesn't mean that it has degraded our offline base because it's all the same. I mean, today, if somebody wants to do anything, go into a store or go to a lab, the first thing they do is Google it and say, okay, what's the closest location to me? And I'll go and click there and book an appointment online and I'll walk in. Now, we would count that as a digital acquisition because it's come from our website, but it could have been already a patient which has already been coming to us offline, right? So we don't see these worlds as so separate. These are worlds that are all going to get completely integrated. So I think we are not internally separating them and saying that, this is the offline business is flat and online business is growing. So we would urge you to also look at them as a more integrated model because that's how it's going to be in the future. And that's how our lives are today, actually. So I think overall, therefore, we don't track them really separately. The only reason that we are even talking about the KPI of acquisitions through digital channels is just for our own discipline to say that we are investing into digital to make it easier for the consumer. And are we getting increased traffic volume through the digital channel as well? And of course, as we understand that the more we are able to move through the digital channel, actually in many ways it reduces the administrative cost that it goes into catering to a patient on certain things, right? You can reduce your call center, you can reduce your other administrative costs if people are digitally engaging with you. So I think the tracking is more for that reason rather than separating them from a revenue perspective.
No, actually, the question was that, like, with these digital initiatives and investments into them, and you are seeing also traffic coming through, but that is not leading to any superior growth than what we would have probably seen in the business. That's what is worrying. That's what I wanted to ask.
Look, I think the question is what is the benchmark in the mind, right? And I think the benchmark clearly cannot be the digital first companies because they follow a very different form of acquisition of customer. So if tomorrow, for example, we had unlimited funding and no worries about losses, it would be very easy to scale up the business because you can go and buy revenue. But if you want to do it in a manner where you're still making profit and you still are getting a customer who's sticky, then obviously the growth is never going to be at a sort of 50-70% number. So I think really the question is about choosing strategically the choices of saying that even though we are on a digital platform, we want to acquire customers that are sticky, that are willing to pay, and that are not just coming to you because you're throwing freebies at them. And so that's not the strategy that we are following, and therefore we don't expect to see crazy growth just because it's a digital channel. Because your way of attracting the customer is still disciplined and good quality, right?
Sure. The second question is on the high tech. I don't know whether you mentioned this with what is the current utilization level for their existing labs?
I don't think we have that number today.
Oh, okay.
But if the question is more around does it need a lot of capex or does it need a lot of expansion and capacity, the answer is no.
No, my question is more about is there a larger scope for utilization? You have mentioned it, better lab utilization. So just wanted to judge like how much of capacity is available.
So we don't have the test-wise capacity utilization. I think that comment comes more from the fact that the variety of test menu done in high tech is quite good, but the volume of tests is not proportionate across the different tests. So there are certain tests in which the volumes are very high, and there are many tests in which the volumes are very low. And so therefore there will be different levels of capacity utilization for each test, but we don't have it test by test today.
Okay. In the same slide, we have mentioned margins are expected to grow 3 to 4%. This is for high tech, is what the target is, right?
That's right.
Okay. Thank you. So the benefits of adding new centers and the labs that we are doing, probably as the another caller also asked you, probably it happened more towards the second half of the calendar year. We will see those benefits coming through over the next, say, 1 year, because I understand these labs are not immediately going to throw big volumes. It takes time, right? So
That's
should.
right.
So
I think the labs
FY20.
that we have set up this year will give obviously some benefit next year. But like you rightly said, I mean, this is more about setting, you're seeding a market, and that will help you over the next sort of 3 to 5 years to 10 years, right? And because you're entering these new markets completely, so there will be obviously some revenue kicker, but considering the volumes will be small, even of the 20 new labs, it may not impact your overall numbers in a drastic way. So I think as we do 90 labs over this next 3-year period in 1,800 centers, together when that infrastructure is completely built, it will obviously add a good revenue kicker for the next few years. But obviously just the 20 labs and 600 centers may not give you that overall big kicker because the volume will not be significant.
So ideally, we should start taking any benefit of those from FY24 probably to have a meaningful number at all, if at all.
Yeah, I mean the benefits will obviously come from year one, but the question is on what are the assumptions in each year. So I think maybe we can come back to you guys with what are sort of the broad historic trends that we are seeing. One thing which we are clearly seeing is that with doing this in a very focused manner, we are able to see a faster break-even than we used to see in the past. So in the past, when we used to start a greenfield lab, we had maximum done only 5-6 labs ever in the history of Metropolis in a year. And we've already done, obviously, like we said, in the last 6 months, we've already done 8, 9, and there's another 10 coming. So that would be the fastest escalation and opening of labs. But more importantly, the way they are being done, the compliance, quality, standardization, and the break-even, we expect to be achieved much faster.
Thank you so much. Wish you best of luck.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Rahul Jivani from IIFL Securities. Please go ahead.
Yeah. Hi. Thanks for taking my question. Can you please quantify the impact which the lower government business had on our overall volumes during the quarter? So we indicated that our non-COVID volumes on a like-to-like basis have grown 11% on a 2-year CAGR basis. So what this number could have been if our government business was not impacted?
We are not giving the breakup of all this business at this point of time for competitive and confidentiality reasons. So as we mentioned, the core business, if you keep aside all the other pieces, is still doing well, and it grew at a 25% year.
Sure, ma'am. And with respect to the government business, do you expect this business to normalize fully in fourth quarter, or would it take us a few quarters before the business stabilizes again?
It has normalized, I think, the end of January.
Okay. And with respect to some of these initiatives or investments on the digital and the leadership team, do you think or what quantum of the investments could sustain going into next year, FY23? And you have guided that the company at this point in time is prioritizing revenue growth over profitability. So going forward, can we see, because of these initiatives as well as the organic network expansion plans which we have, our revenue growth or going forward could be higher than the mid-teens which we have delivered in the past?
I don't think we are at a point to be able to give guidance at this point of time on revenue and profit. What I can tell you is 2-3 things. One thing is, as we said, that the market in general is obviously getting more competitive. It has been for the last couple of years. So I think with COVID, a lot of new entrants, a lot of new players on the tech side as well as on the offline side. And therefore, it's very important that as leaders and incumbents, we continue to up the game. Not only from a talent perspective, from a services perspective, to make sure that the moat around the business is very strong. So we are doing that because that's what's needed to do from the business perspective, in the short term and in the medium and long term. Second of all, the point I made about margins was only about saying that FY21 and 22 were anomalies, the very high margins because of, all the many things we had mentioned before. And these margins are obviously not going to be sustainable going forward. But our attempt is going to be to make sure that our pre-COVID margins
which were also extremely healthy, is what we try to sort of sustain and continue to maintain. So I think the idea is not to really, compromise margins in any very significant way, but the focus is to say how do we continue to make customers delighted, happy, excited in the short and medium term, and how do we put the ingredients in place to drive the revenue. Difficult to comment at this point of time as to what the revenue will come out to be, because there are a lot of moving parts also in the industry.
Okay, but on the margin side, you are saying that despite these incremental investments, we should sustain our pre-COVID margins.
Yes, that's what we are attempting to do.
And do you think that this 300 to 400 basis point of margin improvement, which we are targeting from high-tech, that can help us to improve our overall margin profile despite these incremental investments?
Well, 300 and 400 basis points on high-tech will obviously not give a huge increment on NHL overall, because high-tech itself is not a very, very large percentage of Metropolis, right? So overall, net, we have taken the benefits expected from certain areas and the certain costs and investments, and therefore we've said that keeping in mind the balance of certain things and where we have to invest, the benefits and the costs, we think that the goal will be to try and sustain pre-COVID margins.
Sure, ma'am. Thank you. That's it from my side.
Thank you. The next question is from the line of Sayantan Maji from Credit Suisse. Please go ahead.
Thank you for the opportunity. So I have one question. So when we say that we plan to launch 100 centers in FY23 for high-tech, so this is quite a fast expansion. So where are these centers coming up? So will it be in Chennai or will it be in the other markets? And secondly, will it help in increasing the growth trajectory of high-tech, which has been at a high single digit if you look at it on a 3 or 4 year basis?
Vijender, you want to take that?
First of all, these 100 centers could be across Tamil Nadu, and this includes Chennai, peripheral markets, and rest of Tamil Nadu.
Okay. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, sorry for two of us asking questions. Just a clarity, I joined call a little late, but clarity, employee costs which increased by 10 crore per quarter, is it how much of it would have come from high-tech integration? Can you talk about that?
Rakesh?
So yeah, so we will give you a bit bifurcation right now. We are the out of 10 crore, I think almost 40% increase has because of the high-tech piece. I think around 4 crore, and the rest of the increase has come from the NHL.
Okay, and this 4 to 4.5 crore that you're spending on digital. Okay. First of all, very basic question. So far, as a capex, how much you invested for this digital initiative so far? And so, how much is the capex so far, and how much is the impact on the P&L from the digital initiative? Can you talk about both the numbers?
So capex number, I think we are still in work in progress. A lot of things is happening. So we'll form up our number, and in Q4 we will give you the exact number of capex what we invested in IT, digital infrastructure, and all. So just wait for a quarter to form up. Let us form up the whole number, and then we'll give you the perspective. From an OpEx point of view, as you rightly said, we have spent some 4.5 crore in a quarter. That includes basically the cost on some consultancy which we have taken for the digital part. That also involves the digital marketing cost which we are incurring, and that also involves some manpower cost which we have incurred for the digital piece.
Can you just talk about the digital marketing that you guys are seeing? Honestly, as a customer, when I go for test, I haven't seen too many ads from Metropolis on the digital, whichever platform I visit.
So we are basically more investing into the website where we are getting share of the Google, and other sites which publish when you search the search engine, then you get to know about the Metropolis is coming in the first place or the others are coming in the first place. So we are more getting into that space of a search engine.
Okay. And when you talk about addition of front-end staff, I think, sorry, I've joined late call a little bit. You mentioned about chief revenue officer, etc. So what kind of additions have you talked about, have you done in the team? Can other than chief revenue officer, any more important positions that you want to enumerate over there?
Yeah, so in apart from chief revenue officer, we have added some more people into our digital space. 2 or 3 people have joined in digital space in this quarter. Obviously, we have guided that we have added a lot of people in the front end because we want to strengthen our sales force in the front end team. So mainly the investments are going into digital space, and obviously the leadership team we have added CRO and the lab. Obviously we are also strengthening our lab operations. So these are the 3 areas where we are building up our teams.
And what's the timeline you will be rolling out your app, the new app?
The new app is already ready. Actually, we are just waiting for approval of the App Store to put it on. They've come up with some new regulations in the past 2 months. Otherwise, everything is ready. So hopefully, matter of weeks.
Matter of a week. Okay. Right. Sure. Thank you.
Thank you. The next question is from the line of Akshay Jain from Jain Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just had one question. How do you look at FY23 in terms of growth?
How do we look at it in terms of growth? Well, we'll continue to expand the geographical expansion as we discussed. We'll continue to do all the engagement with consumers, continue to build the product line. All the activities that we mentioned we're going to do, and the revenue growth will always be an outcome, obviously, of that.
Any number that you would like to put to that?
No, I think giving a guidance on revenue at this point or ever, doesn't make sense, frankly. So, I think we should go more by sort of looking at, what are the inputs and how historically Metropolis has performed, and I think we'll stick with that.
Just another question. What is the estimated capex for next 2 years? A ballpark number would also be.
Yeah, so we are spending. Yeah, sorry, you wanted to?
No, go ahead, Rakesh.
Yeah, so in the last 2 years, if you look at, we have spent some, around 25 crore to 30 crore of capex, and as we said that this year we have intensified a bit of our network expansion. We have also invested some in digital. We have also invested some money in the infrastructure upgradation. So overall, we are looking at around 30-40% increase in our capex, which was happening earlier in the last 2 years, and that is how the run rate should continue in the next 1 or 2 years.
Okay. Thank you.
Thank you. The next question is from the line of Prashant Nair from Ambit Capital. Please go ahead.
Yeah, hi, good evening. Just one question on the digital expenses that you mentioned. So is this kind of a new normal in terms of expenses, or do you think some of these will go away after the initial spending?
Yeah, so basically, as I said, that we are just trying to invest into digital space to have more and more clicks into our websites and get more consumers into our fold. So we will continue investing this. Maybe whatever we have invested in Q3, maybe Q4 will see a bit of a lesser investment overall. But this investment, I think, is something which will go on for some quarters before we get into a situation where we feel that organically we are now growing really well because of this investment. So I think it's a matter of 2, 3, 4 quarters where we keep investing into digital space and then reap the benefit in the coming future.
Got it. Thanks. That's it from me.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi. Thanks for the follow-up. Ameera, just one question on high-tech. So on as-is basis, I assume that high-tech was a very well-run and a matured lab and, at network utilization at pretty fair levels. the expansion, the growth we're talking about, as analysts, we should look at growth purely from a top line angle for high-tech going forward, purely because you guys are putting up new centers, and that I think is more Metropolis driven rather than high-tech driven. Or should I look at margin improvements more coming because of cost synergies, because you don't need to replicate a lot of stuff which they were doing because they're two separate entities. So could you help me understand this thing, please? Thank you.
See, when you say it was already a mature entity, it was mature from the perspective that the centers that they had started many, many years ago will obviously now not give, superior growth in terms of same-store growth, right? So those would have matured from a aging perspective, and therefore building new infrastructure, new centers is necessary to give sort of the additional growth. And that's what the goal is that, okay, while you may have, certain level of basic stable growth coming from the existing centers, how do you amp it up and you build new infrastructure to do that? And that's obviously build new collection centers to do that and still continue to feed it with your existing lab infrastructure, which still has capacity to sustain it. In terms of the margin expansion, it will come from the areas that we will make investment. We'll make investment in technology. We'll make investment in manpower, because usually these regional labs do not operate at a mature management level. They operate as single operators by the pathologists who earlier ran them. So they have no management teams, etc. So you have to build the talent to now scale it. So there will be investment in management. There will be investment in technology. There will be investment in upping services and in quality of infrastructure. The front-end services, for example, for patients, and obviously to make sure that everything is compliant and as per system and process of Metropolis and governance. On the positive side, in terms of the cost savings, the cost savings, a large amount will come from material costs, because obviously we get economies of scale in terms of purchasing and negotiation costs of Metropolis, which can be also applied there. And some benefits which will come by integrating the back-end facility. So that's what we are saying, that the margin expansion will come through a combination of these factors.
Right. So essentially that means that the current infrastructure and the patient network essentially was organically also underutilized, right? Apart from the old age lab or collection centers, maybe even the stuff which they would have opened over last 3-4 years, it's still not up to the mark, and hence that is where we can actually come in and get it to par. Is that understanding correct?
When you say not up to the mark, you mean revenue-wise, or you mean infrastructure?
No, infrastructure-wise. So in terms of, you said tech investment, manpower, upping quality of infra, more compliance, and hence you get more scale from the same lab. So basically trying to ramp up the SSSG for stuff which was opened like last 3-4 years. That's what I mean.
No, so see, last 3-4 years, for example, high-tech had not opened much anyway, right? I mean, the total number of centers they have is at approximately 40 centers, of which majority of them would be much earlier. So it's not like there was a big network built in the last 3-4 years. Every year they were opening maybe 2 centers or 3 centers, right? So therefore, it's not that there is a very young network which can be now leveraged by amping up the front end. We have to build the network. So that's what we are saying, is that we'll build the network and then amp up the sales compared to what they were able to do on their own before, by building the network and hopefully improving the way the sales is done itself, right, in terms of sales excellence. So the revenue benefits will definitely accrue to us, but obviously there is a gestation period in building the network and accelerating the sales excellence to be able to get it.
Got it. That really explains, Ameera. Thank you so much, and wish you all the good luck with high-tech, and hope you guys deliver much better stuff. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Ms. Cyndrella Carvalho for closing comments. Over to you, ma'am.
Thank you, everybody, for joining us today. As we talked about, I think there are a lot of exciting things happening in the company, not only with us transforming ourselves with new technology, new ways of operating through new channels, and also our expansion network. Overall, we feel as an organization that's going through a big transformation. And obviously, as we go through a big transformation, there will be a huge number of opportunities and investments that we will have to make sure that we are able to really transform ourselves to become the organization of the future. So at this point of time, as we said, while we continue to be very hopeful and work very hard on making sure that we maintain margins as pre-COVID. The goal will be to try and see how do we really compete, not only from a short-term or long-term, how do we continue to focus on revenue, and how do we continue to build a good quality business, which is sticky and which really stays with Metropolis and is worthy of the brand that we are building over the times to come. It's very easy sometimes to go into markets and, throw money at consumers and customers and get quick business. But we believe that's not really the right strategy to grow. And the right strategy to grow is to do it in a disciplined, sustainable manner that truly gives us long-term value and make sure that we get the customer who values the brand and therefore is willing to pay the price for getting the best quality of report available in the country. I'll leave you with that, and thank you all of you for attending today.
Thank you, members of the management. On behalf of Centrum Broking Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.